So many companies have been recently going bankrupt because they had too much debt on their balance sheet. So in this video, I'm going to show you how you can analyze a balance sheet in order to make sure that none of your stocks have too much debt. We're first going to go line by line and talk about what each line means on the balance sheet. And then we're going to look at how you can use the balance sheet to determine whether debt is manageable or it's too much. But for those of you who are completely new to what a balance sheet is, it's basically broken down into two sections. The first sections are assets. Assets are the valuable things that companies own. These are things like cash, stocks, buildings, and anything of that nature. And the second part of the balance sheet shows the company's liabilities. Liabilities are anything that they owe. The most popular liability is debt. So now let's go line by line and talk about what each line means. We're going to be looking at Apple's balance sheet. The first subheading underneath the balance sheet is current assets. Current assets are any form of asset that can be liquidated and sold within a year. The first listed current asset is cash and cash equivalents. That's really straightforward. It's just cash, money that they have in their bank account that is ready to be spent. The second line is other short-term investments. These are things like CDs. And the next line is net receivables. Net receivables essentially tells us how much money the company is owed for services they have already provided. For example, if Best Buy bought a lot of iPhones but they haven't paid for it yet, this is going to be a net receivable for Apple because they're expecting money from Best Buy. Typically, when businesses do transactions with each other, they don't pay each other right away just because it's really inconvenient, and it allows the business to have more control over what they pay first. So this leads to businesses having net receivables where they're owed money because a business did not pay right away for services that a business provided. And the last current asset line is other current assets. These are things that can be converted into cash fairly quickly that were not listed above. And you can see that Apple has a total amount of current assets of $162 billion, which is a lot of current assets even for their size. The second subheading underneath assets is non-current assets. Unlike current assets, non-current assets are assets that have a life greater than a year. They cannot be converted into cash really quickly. Property, plant, and equipment is any asset that the company has purchased that they're going to use in the long run for more than a year. This can be things like buildings and factories and anything of that nature. It can even be computers and office furniture. It doesn't have to be expensive, it just has to be used for more than 1 year. We can see that Apple has $95 billion in property, plant, and equipment, so they have a lot of long-term assets. Right underneath gross property, plant, and equipment, we see accumulated depreciation for the property, plant, and equipment. And we can see that there is a negative sign. Many people have a common misconception that on a balance sheet, depreciation means that an asset value is falling down, but that's not the case at all. So essentially in accounting, whenever a company buys a long-term asset, like a building, they do not expense the whole thing all in 1 year. They push it out into further accounting periods. This helps reduce having really volatile earnings per share because the company is making a lot of investment. For example, if Apple purchased $1 billion in long-term property, plant, and equipment in 2020, they expect to use the asset for 10 years, they would have $100 million each year to help spread the cost over future years. If they expected to use the asset for 2 years, they would have $500 million in expenses for each year. Then the next line, which is net property, plant, and equipment, it's just the difference between the depreciation and the gross property, plant, and equipment. It shows how much more of the property, plant, and equipment has not been depreciated yet. The next line, equity and other investments, not going to be that important, so I'm just going to skip over it. Goodwill is essentially just how much the company values their brand. So this is really an arbitrary number almost. It doesn't really mean too much when you're making an investing decision. Intangible assets are assets that you cannot touch. They don't have physical, chemical properties that you can touch them. What kind of assets are these? Well, these are things like patents. Currently, Apple has about $2 billion in intangible assets. And right now they have over $300 billion in total assets, which is pretty crazy. And now we're on the next section, which is liabilities. The first section under the liabilities heading is current liabilities. They are liabilities or amounts that are due within the next year. These are just debts that are going to mature within a year and they have to pay back. Pretty simple. The next one, accounts payable, is just the opposite of accounts receivable. Accounts payable is just the money that they owe to other companies for performing services for them. For example, if a company provided services for Apple and Apple just hasn't paid the company back, that would be an accounts payable for Apple because they owe a company money for services that have been already provided. The next line is accrued liabilities. It's really similar to accounts payable. Services have been provided but cash hasn't been paid yet. It's really similar to an accounts payable, so you can think of them as almost the same thing. If you're just using the information to make investing decisions, this difference is not going to matter. It's really just a different type of accounts payable. Deferred revenues. Revenues typically sound good, but in this case, they're actually a liability. They're not bad though at all. They're a good liability kind of. So essentially what happens is, this typically happens when a company is obligated to provide a service in a different accounting period, but they have already received cash for their service. Imagine if Apple announces today that they're coming out with the iPhone 12 next year. A bunch of people are going to pre-order it today, and Apple's going to receive cash. However, they cannot call that amount of money revenue yet because they have not delivered their product or service yet. Once they deliver the product or service, then they can call it revenue. So this is what deferred revenue is. They have received cash for a product or service, but they haven't delivered on it yet. It's a liability because they are obligated to perform a service in the future. And then other current liabilities, it's any other liability that's not listed in one of the lines that's due within a year. And then right underneath the current liabilities are the long-term liabilities. And probably one of the most important things on this balance sheet is the company's long-term debt. This is simply the amount of money they still owe to other banks and they have to pay interest on it. This is a metric we really don't want to be too big. This is the main thing that makes the company's debt not manageable. So we really have to take a good close look at it later on. Deferred tax liability are just taxes they haven't paid yet that they're just going to pay in the next accounting period or next year. Deferred revenues are also listed in the long-term liability section. It was also, if you just watched a couple minutes ago, it was also a current liability. It's the exact same thing as what we talked about earlier with deferred revenues. They received cash for their iPhones, but they haven't delivered their iPhone 12 yet. It's the same scenario, except the product or service is expected to be delivered in more than a year. Then other long-term liabilities are just liabilities that are long-term that were not listed in one of the lines. Then the third and last tiny section of the balance sheet is the stockholders' equity section. I'm going to skip the first line, it's not too useful. The second line under stockholders' equity is their retained earnings. This is just their earnings after they pay out their dividends. It's money that can be reinvested back into the company. The other important line item underneath stockholders' equity, it's total shareholders' equity. You get total shareholders' equity by subtracting their liabilities from their assets. You typically want to see this growing because it kind of indicates that the company is becoming more valuable in general over time. Now let's look at how we can use the balance sheet to help us with our investing decisions. One of the first things you want to look at, and probably one of the most important things you're going to look at, is their long-term debt. You want to make sure that's not too good. You want to make sure that's not too big so that the company doesn't have to fault on it later on in the future. You might be wondering, what is too much debt? Well, we can do this by dividing their free cash flow from their cash flow statement by their long-term debt. Free cash flow is really similar to net income, but it's a more accurate representation of how much cash is coming into the business. It's their operating cash flow minus their capital expenditures. Operating cash flow is just money that came into their business from their main core business, and capital expenditures is investments into assets to help the business run into the future. It's a more accurate representation than net income of the amount of cash that's coming into the business. If you divide their long-term debt by their free cash flow, you want to see a ratio underneath 3. It indicates that the company doesn't have too much debt. And before we move on, I want to talk about the current ratio. The current ratio is a firm's current assets divided by their current liabilities. It essentially shows how well they're able to meet their short-term obligations. I see a lot of people recommending this as a good metric to look for on the balance sheet. However, it's really not that great of a metric. It's not the most accurate representation of how well a company is managing their debt, because a company can have more current liabilities than current assets. It would give them a ratio underneath 1, but they are still able to stay afloat. One reason they're still able to stay afloat even though they have less current assets than they do current liabilities is because not all liabilities are debt like most people think. For example, when we looked at Apple's balance sheet, they had $5 billion in deferred revenue. That's not a debt. They just need to ship products out before they can call their deferred revenue as actual revenue on their income statement. That makes their liability seem much higher than it really is. So there are a lot of companies that can operate with a current ratio that's less than 1 and still be fine. So that's why I really don't like this metric too much. You even see a lot of blue chip companies with a current ratio less than 1. And they've been alive for so long and they're going to be operating for so many years into the future. So I don't really think it's a good estimate of whether a company is liquid in the short term. And the last thing you can look at is their interest expense versus their interest and dividend income. If you go to their investor relations page and look at their most recent annual report, you can click Control F or Command F if you're on Mac to search up for the keyword interest expense or interest income. You can look at their interest income, which is usually listed in the annual report, versus their interest expense. If you see an interest income that's greater than their interest expense, and you can find interest expense on the income statement as well if it's not in the annual report. If they have more interest income, it indicates that the company is not going to have any problems with their debt, or it's very unlikely because the interest is not going to mount and build up against them and compound against them. It's a good sign when a company has more interest income, interest and dividend income versus their interest expense. I hope this video is really helpful for you. Make sure to drop a like and subscribe down below if you want more content like this. And let me know down in the comments if you want me to make a video on the income statement and cash flow statement.